Now let's take a look at illustration number 7 to illustration number 11. All right, we're going to cover all the illustration starting with 7 until 11. Now let's think of a mutual fund. All right. If you think of a mutual fund, the units in a mutual fund, what equity shares are for a company, the units are exactly the same for a mutual fund. All right. Just like I own equity shares in a company, I can also own units in a particular mutual fund. All right. So what equity shares are for a company, units are exactly the same for a mutual fund. All right, so if equity shares are actually getting clubbed under shareholders' funds, if you think of a mutual fund balance sheet as well, you would presume that units are actually supposed to get classified under shareholders' funds. The units which are issued by the mutual fund should ideally be classified under shareholders' funds, following the same thought process as how equity shares are classified in a company's balance sheet. But now, if you actually think of it, generally mutual fund units have got one particular feature. The feature is I, as an investor, I have an ability to always sell the instrument back to the mutual fund entity. All right, I can always redeem the mutual funds by selling the mutual fund units back to the entity. All right, if I sell the mutual funds back to the entity or if I redeem my mutual funds, I will actually receive cash. All right, so if you think of it, I, as a holder, I always actually have an option to redeem the mutual funds. I always have an option to redeem the mutual funds, and this option is referred to as a put option. All right, it's referred to as a put option because I have got a right to sell the mutual fund units to the mutual fund entity. I've got the right to sell the units back to the entity, and therefore, if it is often referred to as a put option. All right, this instrument, the units of the mutual fund can be thought as a puttable in financial instrument. All right, this is often referred to as a puttable financial instrument because the holder has a right to sell the instruments back. The holder has the right to sell the units back to the mutual fund entity. All right, now if you think of it from the mutual fund entity, the mutual fund entity actually has an obligation to pay cash. If I choose to actually redeem my units, if I choose to sell the units back to the entity, the mutual fund actually has an obligation to pay cash. All right, so now there is actually a conflict. Our common sense is actually saying that just like what equity shares are for a company, units are the same for a mutual fund, and hence units issued by a mutual fund should be classified under shareholders' funds. But now, if you logically think of it, this is a puttable financial instrument wherein mutual fund actually has got an obligation to pay cash back to the unit holder or to the investor, and that is basically a characteristic of a liability. All right, so there is actually a conflict. All right, common sense says that it should be a part of shareholders funds, but the true definition of the standard, if you apply it, it actually is satisfying the definition of liability. All right, so the question is, are units issued by a mutual fund, are they actually equity in nature or are they liability in nature? The standard says yes, there is actually an obligation to pay cash, but then this is going to be considered as an exception and it will be allowed to be classified as equity if certain conditions are actually satisfied. All right, so if mutual fund entities have actually issued units which are puttable in nature, all right, it satisfies the definition of liability, but there are certain conditions which are given which, if satisfied, the puttable instruments can be classified as equity instead of liability. All right, let us see what those conditions are. And remember, we actually have to satisfy all the conditions that we're actually going to read. All right, we'll be reading about 6 or so conditions, and if all the conditions are satisfied, only then this will be the puttable instrument will be classified as equity. Even if one of the condition is not satisfied, then we will be classifying it as a financial liability itself. All right, let's look at condition number 1. The instrument, it basically refers to the instrument entitles the holder to a pro rata share in the entity's net assets in the event of liquidation. All right, when the entity is getting liquidated, the unit holder should not be receiving a fixed amount of money. The unit holder should actually receive a pro rata share in the entity's net assets in the company. So condition number 1 is basically stating that the unit holder should be exposed to variability in net assets. If unit holder is actually receiving a fixed amount of cash upon liquidation, liquidation, then it will not satisfy condition 1, and therefore it will be regarded as a financial liability. But if the unit holder is entitled to a pro rata share in the entity's net assets, it means he is exposed to variability in net assets, and therefore it is satisfying condition 1 and will be eligible to be classified as equity, obviously if the other conditions are also satisfied. All right, so condition 1 is the holder should be entitled to a pro rata share in the entity's net assets. What does pro rata mean? If you're holding 10% of the total number of units, you should actually be entitled to 10% of the total net assets. All right, so this is condition number 1. The second condition is it states that this instrument should be subordinate to all other classes of instruments. All right. What does this mean? It basically means that when an entity is actually going into liquidation, this particular instrument holder will receive money at the last after all other liabilities are met. All right. You liquidate all your assets, you start paying off your external creditors, bankers, lenders, and so on. Whatever money is left, only if that money is being received by this unit holders, then that satisfies the condition 2 and is actually in the nature of equity. Remember, to classify something as equity, obviously you actually have to be subordinate to all other classes of instruments, right? Equity shareholders receive money at the last. The first preference will go to the debt holders and external creditors and so on. Whatever is left goes to the equity shareholders. So here also what they're saying is you can classify the units of mutual fund as equity provided these units are actually subordinate to all other classes of instruments. All right, it should be subordinate, meaning their priority comes at the last. They get whatever is actually left out. All right, so the instrument should be subordinate to all other classes of instrument, which means that it has no priority over other claims to the entities to the entity's assets on liquidation. All right, they will actually receive last whatever is left out after other external creditors are paid off. They will then receive the remaining amount. All right, so their priority comes right at the bottom. All right, this is condition number 2. Again, obviously this condition 2 gives you a feeling of equity, right? Like only if this condition 2 is satisfied, it will actually be classified as equity. If condition number 2 actually fails, it means that the instrument is not in the nature of equity. All right, because equity should receive the priority at the last. All right, it should not receive any particular priority. If it is being received, if it is being received a priority, then it cannot be classified as equity and it will be classified as a liability. Then let's go to condition number 3. The third condition is stating that all the financial instruments in the most subordinated class should actually have identical features. All right. To understand what this is actually saying, let us look at illustration number 9. All right. T Motor Limited has issued puttable ordinary shares. Although I was talking about a mutual fund, this is equally applicable for puttable instruments outside a mutual fund scenario also. All right, I took the example of a mutual fund for you to understand, but it is not necessary that whatever exceptions I was discussing was in the context of mutual fund. It can also apply for any other company which actually has puttable instruments. All right, so over here in this case, T Motors is a company which has issued puttable ordinary shares. What does this mean? It basically means these are puttable equity shares where the equity shareholders have got the right to sell the equity shares back to the company at any point in time. So T Limited basically has an obligation to pay cash. The question is, yes, it has an obligation to pay cash, but it will be classified as equity if the conditions are satisfied. All right, and this particular illustration is focusing only on condition 3. All right, so T Motors Limited has issued puttable ordinary shares and puttable A ordinary shares, whereby the holders of ordinary shares are entitled to one vote per share, whereas the holders of A ordinary shares are not entitled to any voting rights. So what T Limited has actually done is it has two classes of shares. One is the normal class of shares and the other is class A. All right, normal and class A. Both of them are ordinary shares, meaning that both of them are equity shares, and both of them actually have a put option, which means both are puttable instruments. All right, so they can be actually put back to the company at any point in time. All right, over here, since they're ordinary shares, obviously it means that they are actually going to receive a pro rata share in the net assets of the company. All right, so condition number 1 is actually satisfied. All right, because they're ordinary shares, obviously they're going to receive a pro rata share in the entity's net net assets at the time of liquidation, and they are also going to be subordinate to other classes of instruments. So condition 1 and condition 2 are actually satisfied. All right, but condition 1 and condition 2 are satisfied by both these puttable shares. It's going to be satisfied by normal class and by class A puttable shares. All right, the question is which of these will actually be treated as equity, or will both be treated as equity? The answer is none of them will be treated as equity, because what the question is what condition 3 actually states is all the financial instruments in the most subordinate class should actually have identical features. Over here we have got two classes of puttable ordinary shares, and they do not have identical features because normal class actually has one vote per share, but class A actually has got no voting rights. All right, both of them are actually satisfying conditions 1 and 2, meaning that they're going to receive a pro rata share in the net assets, and they're also subordinate to other financial instruments, but they do not have identical features. All right, there are two classes of instruments, and therefore it actually fails this third condition because it does not have identical features. As a result, both of them will actually be classified as a financial liability. Condition 3 is actually not satisfied. It is actually failing condition 3, and it will be classified as a financial liability. Over here, they do not have the same identical features because there are two different classes of subordinated financial instruments. All right, there are two classes of subordinated financial instruments having different features, and hence both of them will be classified as a financial liability. Let's actually read the solution. Neither of the two classes of puttable shares can be classified as equity as they do not have identical features due to the difference in voting rights. It is not possible for T Motors to achieve equity classification by designating them as being more subordinate than A ordinary shares, as this does not reflect the fact that two classes of shares are equally entitled to share in entities' net assets on liquidation. What the last part of the solution is trying to actually say is we cannot say that class A is actually inferior to normal class. We cannot say just because class A shares do not have voting rights, we cannot say that class A shares are inferior to normal class, because class A shares are also entitled to a pro rata share in the net assets. All right, the benefit or the share of net assets is the same for both these classes, and therefore just because they have a less voting right, we cannot actually say that class A shares are inferior and therefore normal class should be classified as equity. We cannot actually do such a bifurcation since both of them are entitled to an equal share in net assets and both are subordinate to other classes of instruments. We actually have to evaluate whether these both have the same features or not, and because they don't have the same features, we will be classifying it as a liability. Next, moving on to condition number 4, there is also a condition number 3b which is given, which I will skip for now. That's not relevant over here. I will come back to condition number 3b at a later point. All right, it's not relevant for puttable instruments. All right, condition 3a is relevant for puttable instruments. Condition number 3b is not for puttable instruments. All right, so this is not for puttable instruments. It is for some other type of instrument. All right, so please skip condition number 3b. Condition number 4 is what it is stating is other than this put option that the holder has, apart from the contractual obligation for the issuer to repurchase or redeem the instrument for cash, other than the put option that the holder actually has, there should be no other contractual obligation to deliver a cash or any other financial asset or to settle any variable number of entities' own equity shares. All right, other than this put option, the entity cannot have any obligation to pay cash. For example, an obligation to pay a dividend or an obligation to pay interest or coupon or any obligation to actually convert the new units of mutual fund into a variable number of other equity shares. All right, you cannot actually have any other contractual obligation. The entity should not have any other contractual obligation to deliver cash or to an obligation to issue a variable number of entities' own equity shares. All right, this only if this condition is satisfied, it will be classified as equity. If it is not satisfied, then obviously it means that there is actually a nature of debt and hence it will be classified as a financial liability. All right, so four conditions conditions we have seen till now. Condition one is for such an instrument to be classified as equity. I'm talking more about in the context of units of mutual fund, but it is applicable to a company as well, which has puttable ordinary shares. All right. So for condition one is the unit holder should be entitled to a pro rata share in the entity's net assets. Condition number two is that class of instrument should actually be subordinate to all other classes of instruments, which means that it cannot have a higher priority than other outstanding instruments. All right. Condition number three is that the subordinated class of instruments should actually have identical features. All right. There cannot be more than one class of subordinated instruments. All of them should actually have the same feature. Condition four is that other than this put option, there cannot be any separate contractual obligation to pay cash or an obligation to issue a variable number of equity shares. All right. The only contractual obligation that may exist in this case is with respect to the existence of put option. All right. So that is condition number four. Next, let's look at condition number five. What it is saying is the total cash flows that are attributed to the instrument over the life should substantially be based on profit or changes in entity's recognized assets or changes in the fair value of the entity's assets. All right, whatever cash flow the unit holders are going to receive over the life of the instrument should be primarily driven by the profit or loss of the entity or changes in the fair value of the entity's net assets. All right, this is also trying to indicate that it should be equity in nature where you're participating in the profits or losses of the company. All right, what condition 5 is saying is the predominant cash flows that are actually coming to the unit holder should fundamentally be driven by the profit or loss that the entity has made or any changes or fluctuations in the entity's net assets. All right, if this condition is satisfied, it will be in the nature of equity. If not, it will be a liability. It will be classified as a liability. Condition number six is the issuer must have no other financial instrument or any other contract that has the same cash flows on terms as five above. All right, so there should be no other financial instrument in that entity where the cash flows are predominantly based on the profits of the entity. All right, where the cash flows are based on the profit or loss of the entity, there can only be one class of shares. All right, there can be only one class of instrument. There cannot be another financial instrument which actually has the same cash flows as that of five above, with the effect of substantially restricting or fixing the residual return to the puttable instrument holders. All right, so obviously, if there's another class of instrument which is participating in the profits or losses, then it is obviously going to restrict the return that these puttable instrument holders will actually earn, and therefore, such an instrument will actually not be eligible. The puttable instrument will not be eligible to be classified as equity because there is also another instrument in the organization which is actually participating in the profits or losses, and that is restricting the puttable instrument holders profit. All right, so therefore there can only be one class of instruments which is actually having the ability or where the cash flows are influenced by the profit or loss that the entity is actually making. All right, so that is condition number 6. All right, let's recap all the conditions. First one is a pro rata share in net assets. The second one is with regards to subordinate, there should be no priority over it. The third one is that it should have identical features, meaning you cannot have more than one class of subordinated instruments. The fourth one is there should be no other nature of liability. The entity cannot actually have any other obligation to pay cash with respect to such instrument other than the put option. All right, or no other obligation to deliver a fixed variable number of equity shares. Condition 5 is the cash flows of that instrument should predominantly be driven by the profit or loss or changes in net assets. And the condition 6 is there cannot be any other financial instrument where actually the cash flows are driven by the profit or loss, because existence of such an instrument would basically mean that it is hampering or restricting the return of the normal unit holders. All right, it is restricting the return that the puttable instrument holders will actually earn, and which implies indirectly that the puttable instruments are not completely exposed to the profits or losses of the entity, and hence the puttable instruments cannot actually be classified as equity, and they will be classified as liability. If you carefully read all the conditions, it is trying to actually say that all the nature of equity, whatever is the nature of equity that we commonly understand, all those conditions should be satisfied. And if these conditions are satisfied, even if the entity actually has a put up, even if the entity has a puttable instrument, which means that where the holder has a right to put the share back to the entity, such an instrument will be classified as equity and not as financial liability. All right, although the entity has an obligation to pay cash, it will still be classified as a equity and not as a liability if all these six conditions are actually satisfied. Now let us look at different illustrations, starting with illustration number 7. ABC Limited has two class of puttable shares. All right, so ABC Limited is a company which has two puttable shares, Class A and Class B. Upon liquidation, Class B shareholders are entitled to a pro rata share in entity's residual assets up to a maximum of 10 million. All right, so Class B shareholders are entitled to the pro rata share in net assets, but there is a cap of 10 million. There is no limit to the rights of Class A shareholders to the share in residual assets on liquidation. Examine the nature of financial instrument. We have to examine whether Class A and Class B are financial liability or whether they are equity. All right, this is focusing on condition number 1. All right, what does condition 1 say? The class of shares or the puttable ordinary shares should actually be entitled to a pro rata share in the entity's net assets. All right, both the classes over here are entitled to a pro rata share in the entity's net assets. But if you look at it, Class B actually has a cap. All right. To classify some instrument as equity, you should be completely exposed to the profits or losses. Over here, you're not completely exposed to the profits with respect to Class B instrument, and therefore Class B instrument is actually going to fail the definition of equity. All right, Class B is not entitled to a pro rata share in the net assets because there is a cap involved, and hence Class B is failing condition number 1. Hence, only Class A will be classified as equity and Class B will be classified as a financial liability. All right, let's read the solution. The cap of 10 million means that Class B shares do not have entitlement to a pro rata share in the residual assets of the entity. Therefore, they cannot be classified as equity. Class A will be classified as equity, assuming that the other conditions, which is condition number 2 to 6, are actually satisfied. Let's now look at illustration number 8. Mutual fund X has an investment manager Y. At the inception of the fund, Y had invested a normal or a token amount in units of X. All right. Let us say mutual fund X is having 100 crores. All right. Let us say mutual fund X has raised rupees 100 crores and Y has actually invested, let us say 10,000 rupees. Obviously, Y is the investment manager. What does an investment manager do? He basically runs the mutual fund. All right. In addition to running the mutual fund, Y has also invested a nominal amount or a token amount. He's invested 10,000 and 10,000 is a very small amount in the context of the total size of the mutual fund of 100 crores. Such units rank last for repayment in the event of liquidation. What they are saying is the units that entity Y is actually holding ranks last in the event of liquidation. Accordingly, they constitute the most subordinate class of instruments, and the question is examine the nature of the financial instrument. Now over here, what the question, although it's not explicitly mentioned over here, what actually the question is trying to say is there are basically two types of units. All right. One is the units that are held by outsiders, where outsiders have actually invested the 100 crores, and there is a second class where Y has actually invested. There's a second class of unit which Y has invested a nominal amount of 10,000. What they're saying is the units that Y is holding, such units, which means the units that Y is holding is ranking the last in repayment. Automatically, what is being implied is the units that are held by outsiders, which is of 100 crore rupees, that is not ranked last. All right, that is not ranked last. All right, so there are two classes over here, Class A and Class B, and Class B is held by investment manager Y, and this is actually the most subordinate. It is ranking the last in repayment on liquidation. Class A shares are probably going to receive money just before class Y. All right, first we'll actually pay off all external creditors. After that, we are going to actually repay money to class A unit holders. Class A meaning the outside unit holders, and the units that are held by investment manager Y, which is class B, will actually receive money last in liquidation. All right, now the question is examine the nature of financial instrument. All right, since class B over here, which is held units held by investment manager Y, that is subordinate to all the other classes of instruments, only such units will be classified as equity. The units that are held by external unit holders, since they are actually not subordinate to all other classes, they have a priority over class B. All right. Class B is going to receive the last. Class A has a priority over Class B, and hence it fails condition 2 and therefore will be classified as financial liability. All right, let's lead the solution. The units held by Y are classified as equity as they are the most subordinate class of instruments. However, the units held by other unit holders are classified as financial liability as they are not the most subordinated class. They are entitled to a pro rata share in net assets, but they have a priority over the claims of Y. All right, those unit holders are also actually going to be entitled to a pro rata share in the net assets, just like how class B or units held by Y is also entitled to a pro rata share in the net assets. Class A is also going to be entitled to a pro rata share in the net assets, but the difference is class A has got a priority over class B. All right, therefore only class B, which is the units held by Y, investment manager Y, will be classified as equity, whereas the units held by the external unit holders will be classified as financial liability. All right. Illustration 9 is something that we saw. What illustration 9 is basically trying to say is you can only have you should have only one class of subordinated instruments. All right. You cannot have two classes of subordinated instruments which have different features. All right. There can only be one class of subordinated financial instruments. Let's now move on to illustration number 10. S Limited has issued a class of puttable ordinary shares to T Limited. Besides the put option, which is consistent with other classes of ordinary shares. All right. So S Limited has puttable ordinary shares. There is a put option that T Limited has, which it can actually use to redeem the instrument back for cash. What it is saying is, besides the put option, T Limited is also entitled to convert the class of ordinary shares held into equity instruments of S Limited, whose number will be varying as per the market value of S Limited. All right. So what the question is saying is T Limited has another option also. Apart from this put option, it also has another option where T Limited can actually convert these ordinary shares into a variable number of equity shares. It can convert it into a variable number of equity shares. The question says whose number will vary based on the market value of S Limited. All right, so S Limited may actually have an obligation to deliver variable number of equity shares in future. All right, now obviously an obligation to issue a variable number of equity shares is a characteristic of a liability, and condition number 4 states that other than the put option there cannot be any other characteristic of a liability, and condition 4 is breached. Hence this instrument, the puttable ordinary shares, will actually be classified as a financial liability. The shares cannot classify for equity classification in entirety, as in addition to the put option there is also an obligation to settle the instrument in variable number of entities own equity instrument. All right, so where an entity has an obligation to actually pay cash or an obligation to issue a variable number of equity shares, it means that there is a characteristic of a liability, and therefore the puttable ordinary shares will not be classified as equity instrument. We don't have any illustration for condition 5. We saw illustrations for condition 1, 2, 3, and 4. We don't have any illustrations for condition number 5. And condition number 6, we have illustration number 11. P Limited has issued puttable ordinary shares to Q Limited. Now, in the second sentence, the question is stating that Q Limited has also entered into an asset management contract with P Limited, whereby Q Limited is entitled to 50% of the profit of P Limited. To better understand the question, I want to actually take this entity as R Limited. Instead of Q, I want to actually take this entity as R Limited. The conclusion will not change at all, irrespective of whether this is Q or whether this is R, but it will be easier for me to explain and for you to understand why the condition number 6 actually exists if I actually take this as R Limited. All right, so first sentence is P Limited is issued puttable ordinary shares to Q Limited. All right, so there are two entities. P Limited Limited has issued these ordinary shares to Q, there is another entity called R Limited which has entered into an asset management contract with P Limited, wherein R Limited will be entitled to 50% of the profit of P Limited. All right, so R Limited is basically providing some asset management services, which means it's managing the portfolio of P Limited. All right, as for the services that it is providing, R Limited is actually taking a cut in the profits that the portfolio generates. All right, because R Limited is managing the portfolio of P Limited, what R Limited is saying is, if this portfolio makes a profit, I will take 50% of the profit, and 50% of the profit will be entitled to P Limited shareholders. R Limited will take 50 percentage as a consideration for the services. All right, this 50% of the profit is basically a consideration for the services that R Limited is providing, and P Limited will be basically entitled to the remaining portion of the 50% of profits. All right, so out of the total profits, R gets 50, and the remaining belongs to P Limited, which will then belong to ultimately the shareholders of P Limited. Who are the shareholders of P Limited? Let us say the shareholders are basically Q Limited, right? Because Q Limited is holding these ordinary shares, and therefore what is happening is, on the profit, 50% will go to R Limited, the remaining 50% will effectively belong to Q Limited. Normal commercial terms for similar contracts will entitle the service provider to only 4 to 6% of net profits. What the next sentence is saying is, R Limited, if it provides these services, same services in general market, or if anybody else provides such a service in the general market, the consideration that they take is only 4 to 6% of the profits. Whereas in this case, R Limited is actually taking 50% of the profits. R Limited is taking 50% of the profits as a consideration, which is clearly at off market terms. R Limited is taking a higher amount of consideration than what a general market terms actually would dictate. General market terms dictate 4 to 6 percentage, while R is actually taking 50 percentage of the profits. The question is, examine whether the financial instrument will be classified as equity. The question is, examine whether these puttable ordinary shares will be classified as equity or not. Now, if you think of it, this puttable ordinary shares, let us say it satisfies condition one, it is entitled to pro rata share in net assets. It satisfies condition two, let us say, which is it is subordinate to all other claims. It satisfies condition three, there's only one class of subordinated shares. All right, there is no different feature, different subordinated class having different features. Condition number four also, let us assume that it is actually satisfied, that there is no other obligation to pay cash. Condition number five also, let us assume, obviously, these ordinary shares are entitled, these ordinary shares cash flows are actually going to be driven by the profit or loss that the entity makes. Now, looking at condition six, what condition six states is, the issuer must not have any other financial instrument or a contract. The issuer should not have any other financial instrument or a contract where that contract has got the same cash flows with the terms as in 5 above, wherein that contract has a cash flow which is predominantly driven by the profit or loss of the company. All right, what is the saying? There cannot be any other contract where the cash flows are predominantly driven by the profit or loss. Same terms as 5 basically means there cannot be a contract where the cash flows are predominantly driven by the profit or loss or fluctuations in net assets of the company. Now, why did this condition exist? This condition existed because if such a contract exists, then basically it is restricting the return for the other shareholders. It is restricting the return for the other shareholders. All right, this is basically restricting and is not providing full exposure into profits and losses for the other shareholders, and hence it is actually this, and hence this condition existed. If you carefully look at it over here, Q Limited is ideally entitled to profits of the company because Q Limited is the shareholder. Q Limited is entitled to the profits of the company. But there is parallelly another contract that P Limited has entered into with R Limited, wherein R is taking 50% of the profits, which means this contract is actually having a cash flow which is purely dependent on the profits or losses of the company. And further, this is at off market terms. This is at off market terms. So this cannot be said that this is the consideration for the services being rendered. All right, 50% of the profits is not a consideration for the services being rendered. It is basically another contract where the cash flows are primarily driven by profit or loss, and the existence of this contract with R Limited is going to restrict the profit of Q Limited. Ideally, Q Limited, let us say, should have received profits of 94%. All right. Under this contract, let us say P Limited should have paid only 6% to R. The remaining 94% should have actually gone to Q Limited. But as a result of this contract, instead of 94%, Q Limited is only going to receive the remaining 50% of the profits, and hence the profit or loss that Q Limited is exposed to is actually restricted in this case. Q Limited is not being and is not getting entitled to all the profits of the all the profits that the entity is earning. Q Limited's exposure to profits is actually getting restricted as a result of existence of a contract with R Limited. All right. Since Q Limited is over here not fully exposed to the profits or losses, the Q instrument that Q Limited is holding cannot be classified as equity. The puttable ordinary shares will not be classified as equity because the holder is not fully exposed to the profits or losses, because there is another contract wherein that contract holder is actually getting exposed to some profits, which is basically restricting the variability or restricting the profit participation by Q Limited. Hence, puttable ordinary shares will not be classified as equity and will be classified as a financial liability. All right, so let's read the solution. The puttable ordinary shares cannot qualify for equity classification as, in addition to the put option, there is another contract between issuer and the holder, which is Q Limited. All right, over here, it is not necessary that the contract should exist between P and Q. It can also exist within another party also. The answer does not change just because Q Limited is having the contract. Just because the same ordinary shareholder is having another contract, it does not mean that actually it can be classified as equity. Whether the contract is with Q or whether the contract is with R, because there is actually a parallel contract having the same participation features of profit participation features, the ordinary shares that Q Limited is holding is not going to be classified as equity. All right, so cash flows are substantially based on profit and loss of the issuer, and contractual terms are not similar to a contract between a non-instrument holder and issuer. The market rate is only 4 to 6 percentage, whereas I'm actually giving 50 percentage over here, and it has substantially the effect of restricting the return on the ordinary shares. It is restricting the return on the ordinary shares, and therefore the puttable ordinary shares will actually be classified as financial liability, and it won't be classified as equity. So that is with regards to illustration number 11, which talks more about condition number 6. All right. So with that, we are done with illustration number 7 to illustration number 11, where we were actually talking about from a mutual fund perspective as to whether units of a mutual fund can actually be classified as equity or not. All right, but that was just a way of me trying to explain the concept of a puttable financial instrument. This is equally applicable for any other company also having puttable ordinary shares. All right, I started off so that it's easier for you to understand, but this concept is actually for puttable instruments. All right, everywhere you notice the concept actually states for it is for puttable instruments. All right, puttable instruments, the one of the example is mutual funds and unit trusts, wherein the redemption amount is equal to a proportionate share in the net assets. All right, so this is just an example, but such puttable instruments can exist in other contexts also, and not necessarily in the context of mutual funds only. All right, thank you.